Over the last few years, once interest rates on mortgages started to rise, a lot of home buyers gambled on their mortgage rate, and they believed the age-old lie from real estate agents and mortgage brokers that you date the rate and marry the house, which essentially is a slick way of saying you buy the house now and worry about the interest rate you're going to get later because you can always change that and you can refinance. That's the promise. Here's a story of a couple who did exactly that out of Ponte Vedra Beach in Florida. I don't know how to say that right. They bought back in 2023 and their mortgage rate was 7.6%, but they were happy with the price and they expected rates to drop below 6% within a year and then they would refinance. Well, I wonder where they got that idea that rates are going to drop to 6% within a year. Who told them that? And obviously their plan hasn't exactly gone as expected. Mortgage rates are still hovering right around 6.7% right now, which is making it still pretty unattractive for these people to refinance. And meanwhile, their homeowners insurance for the townhouse they purchased have risen quite substantially. They just listed the property for sale back in March of this year, and they had to cut the price in June. And now their story has changed to the point where they're saying, since we haven't been able to refinance the property, it's not worth carrying it any longer, and it's a bit disappointing. Well, you probably could have prevented that back in 2023 if you would have saw one of these videos back then. That's the harsh truth. And also, why are you selling just a couple years later? You know, when you buy a place, the whole idea is that you're going to be settled in and you're going to stay for a while, whether the plan is to refinance or not. And if your plan was you need to refinance in order to make it affordable, well, then that was probably not such a great idea. And yet many real estate agents right now in 2025 are still telling their clients that if they can afford a payment at today's current mortgage rates, then they should buy while there is less competition and plan to refinance later when mortgage rates decline. So no matter what, this is what real estate agents are going to tell you in order to convince you to buy right now rather than wait for later. And I'm not saying this can never work, because there were people who had rates in the 5s and the 6s and the 7s prior to the pandemic. And then when we saw interest rates drop to the floor down to all the way to 2.5 percentage points for some people, well, that was just like a godsend. A lot of those people refinanced and were able to cut their mortgage payments down by $1,000 a month or cut it in half, something like that. But also, that was an anomaly type situation, and it is not normal for interest rates to drop that far and that fast. It happened because there was a global emergency, or so they say it was. So this isn't something that you're going to see happen on a regular basis. You can't expect this anytime soon to happen again. But the truth is, interest rates for mortgages haven't been below 6% since September of 2022. Unless you're buying a brand new house and you're getting a mortgage rate buy down or a special deal, you're not getting anywhere near that. So unfortunately, all of the buyers who were swindled into this idea of they're going to marry the house and date the rate have been disappointed over the past couple of years and are finding that interest rates, even if they're lower than what they actually first received, are still too high for it to really make a difference and for it to make sense to actually refinance. And right now you have two camps in the housing market. You have people that locked in low interest rates during the pandemic, and you have people that purchased after interest rates started to go up and have much higher interest rates. And that's kind of like the division line of the typical homeowner these days. In fact, there's about 7.5 million households with mortgage rates of 6.5% or higher, and all of those loans were taken out since 2022. And the typical rule of thumb is you want to be able to reduce your interest rate by at least 0.5 percentage point in order for it to make financial sense to refinance. But in my opinion, it needs to be higher than that, because you are going to have costs involved with refinancing. It's not free. And if you're only lowering your payment by a couple $100 and you're going to have to pay thousands of dollars in costs up front to refinance, it probably just isn't going to be worth it, and your break-even time is going to be just too far into the future. Another interesting thing is that economists are not expecting a wave of foreclosures if interest rates stay at the current levels, because the lending rules are stricter than they were before the 2008 housing market crash. But I would push back on that because, as I have mentioned here before, yes, maybe those people could afford those payments at the time 2 or 3 years ago. But even like this couple that we first talked about here, they're already selling 2 years later because the costs to maintain the home have gone up considerably with homeowners insurance. And combine that with the fact that they can't refinance to make their payments make sense, they're forced to sell. So are they a foreclosure yet? No. But what if they're forced to keep the property? What if they can't actually sell it, or they can't sell it for a profit? People in that situation could end up being foreclosure statistics in the future. And to make matters even worse, for people who drank the Kool-Aid about being able to refinance later down the road, home prices are starting to fall in many areas of the country, which means you are having a declining amount of equity, which means a refinance is becoming less and less likely for you unless you have a lot of equity in the property. In fact, a lot of homeowners are finding themselves in a situation now where they are underwater on their mortgage, which means they now owe more on the property than what it's worth. And that is never a good situation to be in as a homeowner, whether you're planning on selling or not. And take a look at this chart right here. This kind of explains everything you need to know about refinancing at the moment. Going back to a year ago, July of 2024, this shows you the amount of homeowners who could save money by refinancing at current rates, and it's barely at 500,000. Whereas maybe last August or September, it was over 1.5 million people. So you're not really saving anything right now by refinancing. And guess what? If Donald Trump actually convinces Jerome Powell and the Fed to lower interest rates, there's a high probability that mortgage rates are actually going to jump because of that decision. That's exactly what happened last year. That's why we have mortgage rates as high as they are now. Because if you don't remember, mortgage rates were actually falling last year until the Fed started cutting rates, and now they're almost just as high as they were when mortgage rates shot way up. And now it's at the point where 1 in 5 Americans who bought since the beginning of 2023 regret taking on such a high mortgage rate, according to a survey by Clever Real Estate. A lot of economists were expecting inflation to get under control much faster than it actually has, and it's still a major issue. And guess what? That didn't happen, which means the Fed isn't lowering interest rates, and even if they do at this point, it probably isn't going to make much of a dent on interest rates for mortgages. They may even go up. Because if the Fed were to lower interest rates right now, with inflation still being a major issue, the people who invest in treasury bonds, particularly the 10-year notes, are going to want a higher return on their investment for taking a higher risk. They're not going to accept a lower payment, otherwise no one's going to buy those treasuries. And that's why if the Fed were to lower interest rates right now, there's a high probability that mortgage rates would actually spike from that decision. And what about the home buyers that were sold the mortgage rate buydowns back in 2022 when interest rates were at their peak, at least for this era? I'm not talking about the highest rate ever for mortgages, but within the last 20 years, back in 2022, mortgage rates reached 8% for some borrowers. And a lot of people were sold this idea of the mortgage rate buy down, which essentially means we're going to give you an artificially low interest rate for the first 2 or 3 years of your loan, and then gradually it will get more and more expensive until you're back up to the original rate. And the whole lie that was sold to those people is we're going to do this, and then you will be able to refinance by the time you're back to an 8% mortgage rate, because there's no way they're going to remain 8%. And they're not 8% anymore. They're not that far away either. Here's an example of a couple who did this in Nashville, Tennessee back in 2023. It's funny how that rhymes. They bought a brand new house and their home builder gave them a mortgage rate buy down, and their original rate was 6.75%. Their rate went down to 4.75% for the first year and 5.75% for the second year. And by the third year, it goes back up to 6.75%. So now fast forward to today, later this year, their rate is expected to rise back up to 6.75%, and they're not going to be able to refinance. That's where rates are right now. In fact, if they were to refinance, look at this. It would actually add $250 a month to their monthly payment, and it will reduce the amount of money they can put towards their retirement savings in the short term. And we actually did see mortgage rates drop down to about 6% back in September of 2024. And some people kind of missed their window to refinance back then. For example, this guy is saying he could have been saving $400 a month if he would have refinanced back then, but he didn't do it. And now he's regretting it because that could have been a car payment for him. Now, if you have the cash, there are some other ways you can still lower your payment. In fact, some people who do have the money are looking at making large payments toward their principal that they owe on the property so that they can recast their mortgage, which essentially will lower their payment. But this only works if you have a lot of extra money to put into the house right now. Most people are looking to refinance because they need the extra money. If they had the extra money to just put towards their principal, they probably would be doing that already. It's kind of like the reverse mortgage situation. Most people who get the reverse mortgage are the people who need it, which is exactly the person who shouldn't be getting it. So what are people doing that are still hoping to get a low mortgage rate? Well, some people are actually on the hunt to find properties where they can buy it with a low interest rate already attached to it, otherwise known as an assumable loan. Now, these are not very common. They used to be back in the day, but not so common anymore. But it does still exist. Here's the problem, because this is like a real life scenario right here. Somebody found a house and the house is $350,000 and the mortgage rate they can assume at only 2.5%. Sounds great, right? Like, why hesitate? Well, the downside is the seller wants $90,000 down in order to do this deal. Well, why is that? This is the reason why. The reason they want the $90,000 down for a $350,000 home, because typically a down payment for that would only be, if you just do 10% down, conventional financing be 35 grand. 70 grand if you do 20% down. But it's probably because the mortgage balance is about $260,000. The buyer is going to be assuming what is left of the outstanding mortgage balance for 2.5%. And this is where it gets a little bit tricky, because they will need to get a second mortgage of $90,000 at a rate of about 7% to cover the remaining balance. Or they can pay it out of pocket if they can afford it. And the next challenge is, when you go to do something like this, is do you want to juggle and do you want to be responsible for two mortgage payments? You could end up saving a little bit of money by having these two separate mortgages, but it might be hard to find a lender that will actually do this, because a lot of lenders are unfamiliar with assumable mortgages since it's not a very common thing anymore. And also, the most common type of loan that is assumed these days is a VA loan. And unless the buyer is actually a veteran of the United States military, then the seller is essentially forfeiting their ability to get a VA loan in the future once they let the buyer assume their ultra low mortgage rate, which can end up being a problem for them later down the road. But here's the other thing that you have to think about. Even if you're able to assume a property like this and get the mortgage payment at 2.5%, you're still going to have closing documents, which means that you're still going to have this real estate transaction recorded as a sale. And because of that, the consequence is most likely that you are going to see an increase in property taxes once your property gets reassessed after the sale. So even though you might be able to assume the seller's current mortgage payment, your payment is still going to be higher once those property taxes are reassessed. You're not going to inherit their property tax payment as well. And even when you see good deals like this and it doesn't look that appealing, once you start really looking at all the pros and cons of the situation, this is why so many home sales are falling apart right now. In fact, as of the latest data from Redfin, in April, 18% of Las Vegas home sales fell through, and the nationwide number was a little over 14%, and it's hovering around 14 to 15% right now. So about 15% of all home sales are falling through across the nation right now, meaning that they originally get a contract to sell the property, and then the buyer changes their mind and the contract gets canceled. And what are the reasons for this? Well, the number one thing are the financial concerns, okay? The high mortgage rates and the high home prices are driving many people to the brink, to the point where they're going to reconsider, should I really be doing this right now? Which is a very smart reconsideration, I think. Not only do people have to pay higher mortgage rates and higher home prices, people have to pay for higher than ever grocery prices, high gas prices, high utility prices, high insurance prices. Everything is up. So buyers right now are being more payment conscious or payment savvy than they really have ever been. And a lot of it's out of necessity, not even out of choice. And a lot of people are reconsidering whether they can actually afford the total cost of homeownership, because that initial payment that your mortgage broker gives you isn't really a true reflection of what you're going to be paying once you own the home. Now, you're going to have your HOA fees if you have that. You're going to have your insurance premiums. You're going to have your property taxes. You're going to have the upkeep and maintenance costs on the home, utilities, whatever. It adds up, guys. People are also hesitating due to all the layoffs. You see how many layoffs we've been talking about here on the channel, and about 800,000 people have lost their jobs since the beginning of the year and counting. In fact, according to Redfin, about 25% of Americans have recently scrapped their plans for a major purchase this year due to the tariffs and due to the financial uncertainty of what we're going through right now. And the next big reason is simply just because there are so many choices right now. Inventory is way up, and you might go under contract on a property, and then a week later you see, wow, there's 5 more homes available in the same neighborhood, and this one might be nicer. This one might have more of the things that I want, and naturally you're curious about that, and you go and see the property, and it ends up being a better fit for you. So it makes sense to cancel that deal and to go ahead and buy the other house. Why wouldn't you? Who wouldn't do that right now? So with the inventory situation climbing, it's giving buyers a lot more choices, which is making them more likely to cancel a contract if they see a better option come up within their due diligence period. And this also gives buyers a much better feeling of confidence about where things are going, and the thought that there might be better deals around the corner, which is making it much easier to cancel a contract. And I encourage everybody to do this, guys. Like, if you are under contract for a place and something else comes along that you think is better, don't cancel right away, but go look at it. And if you think it's going to be a better fit for you, don't hesitate, especially if you're within your due diligence period and there is no consequence to canceling that contract. You literally have nothing to lose, and you're going to get yourself a better deal and a better property for you. Now, one last thing I want to mention is the share of investor home purchases apparently is on the rise, but that is not the full story, and here is why. According to the most recent data from Batch Data, about 27% of all homes sold in the first quarter of this year were bought by investors, which is the highest share in at least 5 years. Right off the bat, it's pretty self-explanatory. Investors bought about 265,000 homes in January through March, which is an increase of about 1.2% year over year. Now, one last thing I want to mention is the share of investor home purchases apparently is on the rise, but that is not the full story, and here is why. According to the most recent data from Batch Data, about 27% of all homes sold in the first quarter of this year were bought by investors, which is the highest share in at least 5 years. Right off the bat, it's pretty self-explanatory. Investors bought about 265,000 homes in January through March, which is an increase of about 1.2% year over year from the same time a year ago. But here's what you have to really look at. Despite the modest annual increase, the rise in the share of investor home purchases is more of a reflection of how much the housing market has actually slowed down, as traditional home buyers are facing growing affordability concerns like we just talked about. So the reason why the amount of investor purchases are going up percentage-wise is because less traditional home buyers are buying right now. So it just makes it look like investors are purchasing more, and they are purchasing more percentage-wise because the amount of home sales overall is going down, and so investors are still buying, but a lot of regular folks are not. So this can give you the illusion that investor purchases are picking up when you see this headline data But what in fact is really happening is the overall amount of home sales is coming down, and the amount of purchases that are happening is just a higher percentage from 1 year ago of investors, only 1.2% more, so not even that much more. But according to the most recent data from Batch Data, investors still own about 20% of the nation's 86 million single-family home housing stock. So they do still have a significant share in the market, but you might have noticed that a lot of investors are also the ones who are turning around and selling these properties as well. Part of the uptick in the amount of listings for sale are investors that are trying to cut their losses right now. So I just wanted to clarify this in case people see this headline on their own and they think, oh, I better jump back in because investors are starting to buy again, which means homes are going to become unaffordable soon. That's not what's happening. Investors are just purchasing a larger share of the homes that are being sold because fewer traditional buyers are buying right now, and that's it. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.